Well, I'm happy to do it. I expect to learn too from it. Um, Let me start out with a little bit of a background, or what I'm going to talk about. Let's do it that way. Um, what did I do? There. Okay. I'm going to just talk a little bit about a background material. Then I'll set the stage for this. Then I'll go to the title that I picked for this, talking about, building off the Clint Eastwood movie, The Good, Bad, the Ugly. Well, I'm going to go the bad, the ugly, and then the good. And I think what we could say is very good in the end. But most importantly, of all this is the lessons that can be learned from what we experienced at Burlington Northern when we went through this trauma that led to this intermodal withdrawal before the BNSF merger. Because I put in here, it's not just lessons learned, but I think lessons that can be relearned. These are eternal lessons for the railroad industry. And you know what they say, that adage is if you don't know history, you're bound to repeat it. Well, there's a chance that could happen. So I think there's a lot to be learned here. Okay, my background, I worked for Burlington Northern Railroad for 17 years in a number of positions starting in the operating department. My last position was leading the Intermodal Business Unit, and then I was on the BN Santa Fe merger team also. After BN, I went to Amtrak, was president of Amtrak's intercity business. Then I went to Menasha Corporation, based in Wisconsin. That's where I am now, and I was president of the Menasha Material Handling Corporation itself. And then I've also become an author. I wrote two books about the history or aspects of the history of Burlington Northern just within the last three and a half years. The first one is Against All Odds, and that's about the intermodal business. And I have a picture of it here, volume three. It's 3 volumes over 1,100 pages. It's a real tome. And this presentation is mostly based off of what's in volume three, but there's some volume two, one and volume two in there too. I also wrote a book called Wow, Did We Ever Make a Difference, about the history of Burlington Northern's grain business, which is a remarkable story, absolutely remarkable. How did I get connected to you folks here? Well, Sandhouse veteran Ed Mosser happened to read the intermodal book and he contacted me. I didn't know Ed. And he says, I participate in these Sandhouse presentations, and I think that group would really, really be fascinated by stories that are in there. So I didn't do anything about it for a couple of years. And then when I finished the grain book, I reached out to Bon French, and I know that Bon's been involved with all things Northwestern. He connected me with Norm, and then that's how we ended up to where we are today. So that's just a little bit of background there. Okay, now setting the stage for this story. Believe it or not, the stage goes back to 1896 when J.P. Morgan reorganized the Northern Pacific Railway bonds into two classes maturing in 1996 and 2046. Northern Pacific was one of the predecessors, one of the Hill Line predecessors of Burlington Northern that got together in the 1970 merger. But those bonds that, Morgan was a brilliant guy. He tied the income from all of the land grants that Northern Pacific Railroad got, and they got the most generous land grants of any railroad in the country. He restricted the income from those grants to be focused on railroad improvements. So in the 1970s through 1980, this is right post the BN merger. BN is pouring tons of money into the Powder River Basin of Wyoming and Montana to prepare for a real boom in coal movements and investing just gobs of money. So through the 1970s, through 1979, BN's revenue grew 289% and its operating income grew 310%. One might say, wow, that's pretty great. Okay, but put it in perspective. The operating ratio at 1979, at the end of this string of years, was 95.3%, and the return on net investment was only 3.8%. That's pretty pathetic, especially when you consider that the prime interest rate hit 15.75% in December. So, one has to really question, how could you afford to how could you justify investing in a railroad business that's generating a 3.8% return, including the returns they got on their resources, when your interest rates are 15.75%? All right. Then in 1980, BN merged with the Frisco Railroad, And then the board finally got frustrated with the relatively poor railroad financial performance and the lack of investments in the resources business, relative lack of investments. And they hired Richard Bressler from Atlantic Richfield Company to be the CEO. And he was quoted as saying that the railroad is a crappy business, I'll put it that way. That was what he thought of the railroad. Okay, so with that BN Frisco merger, Burlington Northern then extended its reach into the southeast. So I have my cursor going here, picked up the territory from St. Louis, Ellsworth, Kansas, Quanah, Fort Worth, and then down to Pensacola, Birmingham. This whole part was the Frisco. The Burlington Northern had through the CB&Q the old Fort Worth and Denver Railroad in Colorado and Southern that went down here, as well as the old CB&Q in this area, the Northern Pacific, which was the southern part of the Northern Lines, and then the Great Northern up here, the SPNS over here. So BN improved its geographic footprint, but from an intermodal standpoint, it was not the best because we didn't have California access, and the two largest markets in the intermodal business for the railroads were California as well as the Northeast, and we didn't have access to those. So that's just part of background. So because of the poor performance of the railroad compared to resources and then the Staggers Act also, BN did three major things in 1981 related to poor railroad profitability, underinvestment in resources. They created strategic business units in the railroad itself. So the Intermodal Business Unit was formed, and it was the first fully integrated strategic business unit in the industry where we had responsibility. And I say we because I was part of that team. It was led by Bill Greenwood. Bill was the terminal super, or he was a division superintendent in Alliance, Nebraska, and I was a train master out in Alliance. So I ended up joining his team in St. Paul. We had terminal responsibility, equipment responsibility, and marketing within our business unit. BN also created business units for the other commodity groups. But Intermodal was treated as a corporate stepchild within this corporation. The kings were coal and grain and really forest products. Those were the biggest areas of focus for the railroad. Um, and the holding company then was created to segregate the railroad from the resource businesses because the railroad leaders, in the opinion of the board, weren't managing the resource businesses properly. They were pouring what resources income they got into the railroad into coal. Okay, so the Intermodal Business Unit is established, the IBU, and we adopted the motto, innovative intermodal service. And we were a bunch of renegades. We just really attacked this business with, unconventional methods. We reduced from 144 piggyback ramps, of which 96 were circus ramps, meaning that you would roll on and roll off trailers on and off cars. That's what it was in 1981. And we reduced that down to 22 mechanized hubs that were run by truckers, which was something that was totally unheard of in the industry. Why would you do any business, get a relationship going with your enemy? Well, we wanted to hire truckers, so we had them to run our hubs, and that conversion occurred by March 1985. And while Burlington Northern was 100% mechanized, lift on, lift off, in all of our facilities in 1985. The whole industry was only 32% mechanized in 1985 to give you a relative feel for how significant of an accomplishment that was. We also aggressively tested and adopted new equipment technologies. Everything that was possible, we tried out. And we, as rapid as possible, adopted new equipment technologies. We introduced common user double stack services and dedicated intermodal trains to run between our hub centers so that by the end of 1996, 90% of our business in intermodal was run on dedicated trains, and we were running a common user double stack train to offer service to steamship companies that couldn't afford to buy their own double stack trains, like the APL, Sealands, K-Lines, Maersks of the world. And then we also introduced the expediters, BN expediters, by the end of 86 with two-man crews in it started out in the Springfield region, the former Frisco, in order to attack markets that were just dominated by truckers. And we believed with a lower cost structure, we could get into those markets. So that's what BN Expediter was. Then we also introduced BN America as the first railroad-controlled domestic container business in April of 1988 to restructure the domestic and international U.S. intermodal supply chains. So we were doing all kinds of innovative things. And this is what our route system looked like in 1988. The lines in silver, which you can see here, are all expediter routes. Where every place you see a star was actually a BN hub center. And there's even one in Detroit because we negotiated a deal for a haulage agreement with GTW to put a hub in Detroit. We had satellite hub centers run via highway throughout the Southeast and then through other parts of our system where we couldn't justify having a rail hub, but we would feed our rail hubs via highway. So that's background. Now the bad though. The CNNW and UP entered the Powder River Basin in late 1984. And when you couple that market entrance with subsequent coal rate case losses and the ETSI settlement, and if you don't know what ETSI was, that was the coal slurry pipeline that was proposed to move Powder River Basin coal into Texas, Arkansas, Louisiana, the Southeast. And the railroads colluded to keep them out. And there was a big antitrust case raised there, and BN ended up getting stuck with about $175 million for a settlement out of that case. Santa Fe ended up in court, and theirs was started out at $1 billion. So it was a big, big deal. All right. So a combination of all these factors really just whacked Burlington Northern's coal market share and profits. So that was a big source of cash for us. That was being diminished. Then I told you about those bonds, the JP Morgan bonds. Well, when Bressler came, he wanted to really capitalize on all the land grants that were still remaining within the BN portfolio, but he was inhibited from investing into the resources business from those grants because of that tie that the attachment of the land and mineral rights to the railroad. So on January, let's see, I have to look at my sheet here because I can't see. January 12th, 1988, the court finally approved a detachment of the land and mineral rights. Okay, so now there goes that source of cash. Then, with that ability, then Bressler convinced the board to split Burlington Resources, the resources businesses, out of Burlington Northern Inc., and that was in the end of 1988. But the Burlington Northern Railroad, which became the new BN Inc., it assumed $2.8 billion of long-term debt, and that included $1.5 billion of debt that were related to acquisitions of El Paso Energy and Southland Royalty Trust that the holding company had made to build up the resources business. So the railroad got stung with $2.8 billion of debt, more than half of which was solely related to resources businesses, but that's what was inherited. So the post-split, the post-BN Railroad, Burlington Resources split, gave then this new BN Railroad a debt-to-equity ratio of 76% compared to only 27% back with a combined company in 1982. Highly, highly leveraged. Okay, more bad. BN's board and CEO then adopted a debt paydown strategy as the top company priority effective 1989, and locomotive investment lagged badly. And at the same time, Dryas Gaskins, who was by far the most, he was the greatest leader I ever worked for. Bill Green was close, but Dryas, what he accomplished was absolutely remarkable. He was pushed out. Okay, he ended up going onto the board, but he was kind of like dehorned on the board. He was pushed out. Between 1984 and 1991, Burlington Northern's current dollar cash from rail operations fell from $1.09 billion to only $393 million. Um, just things weren't, especially after Gaskins left, things really started to go off the rail. And if you look at current dollars, that's in, or look at inflated dollars, I mean, that's current dollars. The number for equivalent number for 1991 was only $343 million. So the railroad was on a really a dire course. So then in 1992, because things didn't improve a lot, Burlington Northern's board and CEO adopted both operating ratio and debt paydown as the two top corporate priorities in 1992. And again, no locomotive investments, no. You do with what you have. Then on top of that, the majority of Burlington Northern executives believed it should be a bulk railroad. That, okay, we're in an asset rationing position. We should ration our assets to the bulk business because that's where the majority of the money was made. And then on top of that, in a kind of like this battle for survival, BN's intermodal business lost focus, and the intermodal business unit was actually disintegrated in September of 1991. So what had been a stepchild all this time really became a bastard, an illegitimate child of the railroad. Here's the locomotive picture. You can see what happened right after the Frisco merger in 1980. You can see Burlington Northern's locomotive count, that's on the left, freight locomotives, and how that was brought down. A lot of work on productivity improvements. There was a bump up in 84 because we were still gaining coal market share until the UP-CNW came. And look at what was going on with revenue ton miles per locomotive. Incredible increases in productivity, just remarkable increases until look at what? You get to 1989 and it's flat. The locomotive fleet is flat, in fact, going down a bit, and the revenue ton miles per locomotive flat. We hit a wall, absolutely hit a wall, and there was really not much of an opportunity for growth as a result. Now, another aspect of the ugly is that when intermodal was broken up, they commissioned an inside task force to take a hard look at the intermodal business, and the picture was pretty ugly. This is a slide from the actual Intermodal Business Unit Task Force presentation that was made to senior management. And by the way, I was not a part of this business at this time. I had left the intermodal business in 88 to move on to other things within the company. But you can see that the business was evaluated based on short-term margin, mid-term margin, and long-term margin. Where long-term margin, you have your fully allocated costs. And the domestic business, and that was trailer business, generated $70 million of short-term margin, 13 million of midterm, that would be your long-range incremental costs, and then fully allocated almost a $19 million loss. This nascent Burlington BN America business, just trying to build this domestic container business, it was only generating 25.5 million of short-term margin. It was actually losing money according to the task force based on long-range incremental costs and long-term margin loss of 15 million. The international business was profitable against all three measures. But the important things to look at here are the $179 million of short-term margin that the business contributed, but the $25 million long-term loss. And that's what was focused on, the $25 million long-term loss. So the business was given a directive that, well, first off, the return on assets was calculated before I get to the directive. You take those numbers, and this is, I know this is an eye chart here, but the key things to focus on here are that the return on assets, when you put all of that full-term after-tax contribution against a $357 million intermodal asset base based on the market value of assets, not the book value, but the market value of assets, meaning that let's say we have a hub center in Irving, Texas, which we did, and it was right on the airport freeway, prime commercial property. It was probably worth market value about $10 million, but it was on the books of the railroad down at, 2 million. So it hit the asset base for the $10 million. Okay, with that background, the business was generating a return on assets according to the task force of a negative 4.4%. So it got a mandate that there would be a target of a 10.2% return on assets plus a senior management directed financial return. To generate a 10.2% ROA, the income of the business had to increase by $83 million. And that would be $58 million after tax, assuming that the market value of the assets owned by Intermodal remained the same. All right, so yours truly was plucked to assume this challenge. So I was taken out of the equipment management group and I was told that I was going to be the leader of this business. And it was one of those deals like Mission Impossible, Mr. Phelps, this is your task sheet, you decide to accept it. Well, I wasn't given a choice. I said, this is your job. Okay. So I assumed responsibility for the restored intermodal business unit, and restoring the business unit to be fully integrated was one of the conditions I had to take the job. That happened in September of 1992, so I got accountability for that financial challenge. The directive was to exceed the 10.2% ROA hurdle by the end of 1995. Now, just as a matter of fact, the comparable after-tax 1991 Burlington Northern Railroad overall ROA was only 4.6%, and not based on market value, but based on book value. So the intermodal group got a challenge that was beyond what the railroad was dealing with. What did we do? We got the group back together again. I knew most of the people because I had come out of the intermodal business, and we took immediate actions to focus on basic blocking and tackling to enhance service, enhance profitability, while also formulating a multi-pronged strategic plan. And that plan was finally accepted by the corporation in September of 1993. And I'm going to pull some pages right out of that plan presentation. This is just a brief summary. We pointed out that we've significantly improved the profitability of the existing intermodal franchise just within a year. And I'll show you exactly what that was. We evaluated 6 franchise downsizing and expansion options, and I'll show you what those were evaluated at. We pointed out that the intermodal business was just ripe for growth, not just international, but domestic also. We pointed out that our competitors were expanding their franchises through targeted alliances, like UP getting trackage rights over CN&W into Chicago, UP and APL basically being in bed together, CSX owning Sealand and their CSX intermodal business being the manager of the entire North American Sealand franchise inland, for intermodal movements. Those kinds of targeted alliances. Even CSXI was really, really close to the SP and DRGW combination. And, we thought, well, they basically could run them. They had so much market power. So we were seeing our competitors getting very, very strong, and we weren't. So we evaluated alliance options, and we deemed that alliance options moving outside of the Burlington Northern geographic franchise generated much higher shareholder value than just a standalone BN franchise. So we told the corporation, and one of the things we looked at was getting out of the business. Should we just get out of the business or just rationalize it down to just the Northern Corridor, which is our core, or others that I'll show you in just a second, moving to a Western, then National Intermodal Alliance? This is what we said we needed to pursue, which was a national intermodal footprint, which included Santa Fe and Norfolk Southern. And it's kind of interesting, given the news that you've had, that that's probably never going to happen. But you can also see a line here that goes to New Jersey. That's because we had a deal with Conrail where we had a hub center at Croxton. So we had exposure there. We were into Detroit on GTW and so on. And I had been working with Santa Fe to try to combine our intermodal franchises from the moment I took the intermodal job in September of 82. I was working with Don McGinnis on that. And then that ended up leading into the merger discussions. But this was our vision, okay? We needed to have that. Why? So that we could be competitive with nationwide truckload carriers. And if we're not going to be directly competitive with them, to be attractive to them so that we could have a whole different commercial relationship between the truckload sector and the railroad, but also be much more attractive to UPS and LTL carriers, being able to give them a single source of broad geographic coverage. Take away that horrible fragmentation that's just afflicted the industry from the time that it started out. Okay, I talked about these options that we looked at. I didn't put financials here in the presentation that we gave to senior management on the exit strategy because it just didn't make sense at all. Now, the limited core was just running the northern corridor, just the line between Chicago and Seattle and Portland, basically, through Minneapolis, St. Paul. That would generate a 13.8% after-tax ROA if you could assume that all the fixed costs and the fixed infrastructure that the intermodal group was absorbing costs for, if all that was shed, it just kind of like went away. Oh my gosh, you can get a 13.8% return on that. But you know what? Those costs don't go away. So the true measure of the assessment of the ROA for that strategy was only 3%. If we shrink back to just an extended core, such as getting out of Texas, for example, if you could shed all those assets that you weren't going to be using anymore, you could have a 12.2% ROA. But not all those assets are going to go away. And it wasn't just Texas we were looking at with regard to an extended core. If you'd be looking at a 9% return otherwise. Remember, our target's 10.2. The regional railroad, that was the railroad that we were operating. We said we could generate a 10.4% return on assets on that if we are successful in implementing all of our strategies, but that wasn't going to be good enough. If you combine us with the Santa Fe, the business would generate a 20.1% ROA, and the net present value was much, much higher. Not only a higher ROA, but a significantly higher NPV also. If we could go to a national alliance, it's even better yet, because you get so many more efficiencies when you have a broader network for equipment management, drayage management, channel management, all these different things. So it was by far the most attractive option for us and generated by far the highest net present value also. So that was the assessment of the options that we had available to us. Now, I said there was significant progress made in 1993. We increased our revenue $63 million. We dropped $56 million of that to the bottom line. Well, how do you do that? We just focused on basic blocking and tackling, better equipment management, better hitch utilization, better drayage management, strategic pricing moves, incorporating steamship containers, managing them through our BNA service center to take them off the hands of steamship lines so that they won't have them to crash domestic prices going westbound. We would take those containers and use them for UPS, LTL, and all that. We got the ROA up to 6.6% in 1993. Even though the operating ratio, look at that, it was 95%. That's not a real attractive operating ratio from a railroad standpoint. But because of asset velocity, you get a decent ROA. Okay, we'll continue with the ugly here. BN's continued focus on debt reduction and operating ratio restricted locomotive fleet growth and intensified pressure to allocate them to coal and grain. And what really was a devastating blow was the 500-year floods that we experienced in 1993. Some of you may remember those, but BN was by far the most affected, most afflicted railroad of all of the railroads in the United States. And that compounded our locomotive bind because of extended network disruptions, and it just crushed productivity. It took way more assets to produce the same or less amount of business. For example, our coal contracts held that the coal companies, the utilities, not the coal companies, but the utilities, because they controlled the freight, they could order us to put more train sets in service if we weren't delivering enough coal for them. And through the flood, the stockpiles of coal at the utilities got perilously low. So the utilities kept ordering more and more coal sets into service, but that just caused more and more network congestion. It was a horrible, horrible experience. The ugly continued. Efforts to combine with Santa Fe hit repeated walls. Just couldn't get over the goal line. And the book that I wrote, it talks all about all the drama related to all that was going on with that merger. A critical element of the intermodal plan was to win Taiwan's Evergreen Marines business in 1994. They are one of the largest steamship companies around, and the Union Pacific had their business. It was up for renewal in 1994. The contract was up for renewal, and that business fit beautifully into our network. And we knew that we could fold some of their container capacity into our BN America network so that we could get more capacity for domestic moves and reduce Evergreen's costs of moving empty containers back to the West so we could get their business without having to crash prices. So it just fit our opportunities wonderfully. But here was the Evergreen dilemma. We needed 17 additional locomotives to handle Evergreen, and we had this business incorporated in our 1994 plan. But before, you know, I would go to Taiwan, to Taipei and New Jersey. Evergreen was managed in the United States, in New Jersey, and globally in Taipei. Before I could go to them and say, yes, we can commit to handling your business and all that, I wanted to make sure we had locomotives to run it. So I went to Jerry Grinstein, who was our CEO, and his C-suite, all of his chief officers, and said, this is a dilemma. This business is in our plan. It fits beautifully. Can I have commitment to get 17 additional locomotives that are already built into our plan? Will I get those locomotives? And all of them except Bill Greenwood said, no, I couldn't. Well, Bill Greenwood had been dehorned in 1992. He had been the chief operating officer and he was relegated to head of marketing. So he lost a tremendous amount of influence, which was a tragic thing. The loss of Darius Gaskins and what happened to Bill Greenwood were just tragedies within Burlington Northern. So now what am I going to do? I have this 10.2% ROA mandate, and they're saying I can't get locomotives for Evergreen. So I said, okay, all right, you keep saying to me, we're going to reallocate. All right, our lowest profit segment was our business on intermodal trains to and from the hub centers in Dallas and Fort Worth. They generated $114 million of revenue and midterm margin of $8.5 million in 1993. And you may think, well, that's not that attractive. 8.5 million on 114 million of revenue. Okay. And that's what the rest of the company thought too. And like I said before, Evergreen's business was a superb core franchise fit. So what do? I explained the Evergreen dilemma and the Texas trade-off, including the revenue and margin numbers to the C-suite. And I stress that it's not the kind of a deal where we could say, well, we'll just withdraw from the Pacific Northwest to Texas market or withdraw from the Chicago to Texas market, because once you've done that, you've destroyed the economics, you destroyed the overall profitability of the hub centers because the remaining business isn't enough to make those hubs viable. Plus, you destroy your drayage economics. You lose the opportunities for having enough critical mass to have two-way hauls in your drayage networks. So, the bulk railroad biased CFO, Executive Vice President of Operations, and EVP of coal all said that they doubted if the entire Burlington Northern intermodal franchise, the entire franchise, generated $8.5 million of midterm margin. They thought that we were just an absolute loser, a total drag on the system. So I said, well, you're wrong. But I said, look, if I can't get the 17 locomotives from you, how about we withdraw from the Dallas and Houston markets, but we retain our Texas-related locomotives because you already have them in our fixed asset base. We're already paying for them according to the financials that you've imposed on us. And then we could keep them if we to redeploy them if we withdraw from Texas. But we knew our activity-based economics better than anybody in the whole corporation. And we had started working on activity-based accounting in intermodal back in 1982 when actually in 1981 when we first got into the business. We first created the business unit. And I told the C-suite that if we withdraw from Texas, it will cost BN at least $30 million of operating income a year due to sticky overhead that would no longer be absorbed by intermodal. At least $30 million. And they're saying, BS. You're saying that it has $8.5 million of midterm margin. You're full of crap. And I said, no, it's not that way. In a high fixed cost, high shared asset business, you cannot look at such a decision through a financial accounting lens. You have to use an activity-based, cash-focused, managerial accounting approach. And so what did I get for that? I was called parochial. I said, I'm only looking out for intermodal. I was called indecisive because they said, you should have pulled out of Texas a long time ago. And they diplomatically, I said, I was full of dung. Okay. So I said, fine, fine. Can I have authority to withdraw from Texas? And I got it. So we withdrew from Texas April 1, but we were able to retain the locomotives related to that business. So that then gave us this network, which was a step back from where we wanted to go. We wanted to have national coverage. Now we've cut out one of the largest growing markets in the whole country. It hurt. Gosh, that hurt so badly. So now here we have our headquarters in Fort Worth, Texas, and we don't even serve it in intermodal. But you can see all the other places we serve either directly or with partnerships with railroads or with the highway satellite operations. So this was a real blow to us to lose that part of our network compared to what our plan was. What did we do with those locomotives? We redeployed the Chicago, Texas locomotives to a new Seattle, Chicago service. We redeployed the St. Louis to Texas locomotives to a new St. Paul, Chicago service, primarily for UPS. We redeployed the Portland, Texas locomotives to a new Kansas City to Portland service that still left us 17 more locomotives available for Evergreen. We worked with the KCS to generate an alternate interline service to run from Kansas City to Dallas, especially to serve the steamship company Westwood, which only served the Pacific Northwest. We were their sole source provider of rail service, and we needed to get them access into Dallas. And what happened? Like I said, BN's financial performance immediately deteriorated. How so? Okay, April 1 is when the withdrawal was effective. And this is what our April 1994 budget performance was, or performance was compared to budget in all of Burlington Northern Railroad in that first month. And look at coal. It beat its revenue budget by $8.4 million, 6.5% positive variance in a railroad that overall exceeded the revenue budget by $900,000, in spite of the fact that intermodal came in $8 million below plan, 12.4% below plan. But what happened? Operating income fell 21% below plan, $13.7 million. Operating ratio, 3.3 points off of the plan. Net income, that's after tax, 8.5 million below plan, 26.6% below plan. Earnings per share down 27.3%. I told them what was going to happen. They said I was full of shit, and it happened. Okay, so the finance department and operations then performed a joint independent Texas post audit. Was this intermodal group really telling the truth, or was something else going on here? It confirmed that the true annual operating income impact of the Texas withdrawal was actually not just 30 million like I said it would be. I said it'll be at least 30. They said it was 30 to 35 million, solely related to intermodal's withdrawal from Texas. In addition, operations had been utilizing capacity on our Texas intermodal trains for merchandise business. All right, when we pulled out, that left that business hanging. Customers went nuts. Okay, so operations restored service to those markets without the benefit of intermodal business. That increased the operating loss to at least $54 million a year. 30 to 35 million just related to intermodal. Now you've got merchandise losses because you have losing trains or put on to save that business. The conclusion in the analysis that was written by these people was, if nothing else, and this is the quote right out of that document, which is in the book, this confirms the notion that in a highly leveraged, I want to make sure I read this properly, in a highly leveraged cost structure of the railroad, it is in the short run considerably easier to shed business than it is to shed cost. If long run capacity exists, volume is essential to leverage the fixed costs and minimize unit costs. Okay, so now here's another issue that puts salt in the wounds. As I said, the request for 17 budgeted locomotives for Evergreen was denied. 30 to 35 million business worth of business was lost. That's the operating income. That was worth 19 to 23 million dollars of net income based on our tax rate. In 1993, Santa Fe bought 100 GE C-44 locomotives at a cost of $1.2 million each. And they were especially suited for intermodal service, which we were not allowed to do on BN. We could not buy locomotives for intermodal. These C-44s generated 4,400 horsepower. They consumed 80 gallons of fuel per hour compared to the locomotives that we were using in BN Intermodal, which were the old SD40-2s, 3,000 horsepower, 180 gallons of fuel per hour. So we could have gone with these C-44s if we had had them 2 for 3. Two of those locomotives would have been worth 3 of our locomotives. In addition, we could have had 55% better fuel efficiency. And those of you that know railroad costs know that fuel is one of the highest cost elements in a railroad operation. Okay? The foregone income from this is just related to intermodal. Okay, the foregone income from 1 year of intermodal Texas business could have bought 16 to 19 C-44 locomotives. We told them, and we were told we were full of shit. Okay, so how about the good though? I said we went from the bad to the ugly, and boy, was that butt ugly. Okay, but we go to the good. Well, with that knowledge that we would be able to hold on to those locomotives, we went to Taipei, we went to New Jersey and said, we'll be there for you, Evergreen. We're going to make you delighted with our service. We were notified on May 27th of 1994 that we won their business effective on July 1st. It was a critical component of the plan to successfully achieve our intermodal financial turnaround, even though we didn't have the Texas piece in the portfolio. It was also a critical component of how BN's intermodal business helped enable the BN Santa Fe merger, because those of you that are students of that history know that we ended up in a bidding war with Union Pacific. And I cite this in the intermodal book. I give all kinds of details about it. But our coal business, profit-wise, really laid an egg. And it was up to intermodal's profit improvement and the grain unit's profit improvement that saved the day to make that to keep BN in the game, to make that merger happen. But that's a whole nother story. Okay, so in 1994, we got our return on assets up to 9.8%, got the operating ratio down to 93%. And the outlook at the end of 94 was that we were going to hit our target. We'll actually hit a 12.3% return on assets. We'd get our operating ratio for intermodal down to 91. But the changes that we made proved even better than we expected that they would. In fact, in the first quarter of 1994, with the benefit of Evergreen and the redeployments that we did with our locomotives, even though we didn't have the benefit of $30 to $35 million of income from Texas, okay, in the first quarter of 1994, this shows you the margin growth that occurred year to year, 1994 over 1993, compared to RTM growth. BN's revenue ton miles for coal went up 21% because all the assets were being focused on coal. And by the way, we're getting SD70 Mac locomotives by that time. They weren't available at the time of the withdrawal from Texas. They started to come on right at the end of 1994 in a big way. Or I should take it back, not the end of 94, in the end of 1993 in a big way. So you can see that BN was carrying all kinds more coal, but it wasn't dropping to bottom line. On the other hand, our grain unit was having a bumper crop year. Revenue ton miles in the first quarter were up 62%, and margin growth was up 29%, but $26 million. That was a lot. You might say, why would margin growth only be up 29% or 30% compared to a 62% growth in RTMs? That I talk about in great detail in the grain book. But it was because the growth was in corn and soybeans rather than wheat. And those were the lowest profit components, lowest profit segments of the grain portfolio. Look at the bottom though. Intermodal's margin growth in the first quarter of 94 over 93, up $11.1 million, 40.6%. on a growth of only 7.8% of RTMs. By the way, that 7.8% RTM growth is factoring in the fact that we didn't have the Texas portfolio in 1994 that we did in 1993. So that growth is in spite of the loss of Texas. So you could see that all the things that we promised the corporation, we were cooking on all cylinders. It was fabulous, absolutely fabulous. So, what are some lessons here from this? These are eternal lessons, okay, from this experience. One, beware of attempts to abandon growth or shrink to achieve prosperity, especially in a leveraged, highly fixed cost or fixed asset railroad. Two, beware of locomotive underinvestment. If you're caught short of locomotives, frankly, you're going to be screwed in a railroad. You cannot skimp on locomotives. Three, beware of a dependence on financial versus activity-based managerial accounting for railroad asset allocation decisions. Next, beware of an overemphasis on operating ratios. You know, people would look at a railroad operating ratio of 92 and say, that's a dying business. Not in intermodal, not with the asset velocity you get in that business. Beware of an overemphasis on arbitrary fixed cost allocation. Boy, it surely doesn't serve a purpose. Beware of not emphasizing velocity and true return on assets in a business like railroads. And we were passionate about that in intermodal from the start. And when I was in equipment management, beware of favoring either or instead of both and solutions. It shouldn't have been with or without Texas. That's an either or. Texas was it 30 to 35 million dollars of profit contribution for us. And you saw what happened when we lost it. You have to search out both and solutions in a railroad business. So notice I say retaught. Why would I say that? You can go back to the 1850s, and I took this quote out of Styles' book, The First Tycoon, about Cornelius Vanderbilt. And it says, Vanderbilt sorely wanted the long distance passengers and through freight that came from the west via the Central, no matter how little revenue he received. I don't necessarily agree with that part. Unlike a steamboat and steamship line, a railroad suffers from high fixed costs. It was an immovable piece of infrastructure, whether trains ran or not. The tracks, bridges, buildings, locomotives, and cars had to be maintained. Conductors, engineers, firemen, and laborers had to be paid. At least two-thirds of a railroad's expenses remained constant no matter how much or how little traffic it carried. If the Commodore could get additional business even at losing rates, it would improve the Harlem's outlook. Okay, so losing rates, put that in quotes. I would never condone taking on business at losing rates, but it's based on what level of costs. Okay, there are cases like when we brought on expediters, we were doing that for cash because we had parts of the railroad that you could shoot a cannon on at most times of the day and not hit anything. Okay, and that right away was still being maintained, and we weren't going to abandon it and all that. So that's why I say that this is a lesson that was retaught. And it looks like I've talked too much, so I'm going to turn this over to questions. Should I take off screen share?
Uh, you know, that would be good. Why not?
Okay.
So I'm going to send a chat message. But again, I just want to remind everybody, if you'd like to ask a question, there is a button called React with a heart above it. Somewhere in your Zoom screen, if you click on the heart, you can raise your hand. There's a raise hand link. And do that, and I'll go down my list and I'll ask people to unmute. All right, David Fisher.
Good morning. Thank you for the excellent presentation, Mr. Kane. Uh, could you briefly speak to the reaction after about I guess the economists would call operating contribution contributing against fixed costs within the organization after you were basically proven right, and if that made any changes?
Actually, it didn't. Um, the analysis proved it right. We said it would be that way. The study proved it right, but I ended up losing my job. They brought in a guy from DHL to take over the intermodal business and brought in a guy from Frito-Lay to slash costs like crazy before the BN Santa Fe merger. So even in spite of this, the company still couldn't get it through its head that this is the way railroad economics worked. Believe it or not.
This is a group that's never shy to ask questions, so I know we have some more out there.
Fire away.
I also indicated if you want to send me a chat that you've got a question, we can do it that way as well if that's easier. Norm, do you have any questions?
I guess I'm somewhat amazed at the reaction of the people in BN headquarters because railroads have always been a volume business and utilities have always been a volume business where you have such high fixed costs. And, I'm almost flabbergasted in what Mark has been saying about the inability for them to grasp it. So I guess my question is these people in the C-suites, what was their backgrounds? What industries were they in before they ended up in the C-suite at BN?
Well, the CEO was a politician. He had run Western Airlines, but he wasn't an operating man at all. He was a politician. He had been the chief of staff for Warren Magnuson, and he looked at everything through a political lens. So he was not strong financially. The CFO came from Federal Express, and he had been with Fred Smith for a long time. Um, I don't understand why he couldn't see it. Although, in an LTL business, you tend to have more of a fixed asset, base, but he didn't seem to get it. The guy that was the head of the coal group had been a McKinsey consultant. He was brought in to actually take Bill Greenwood's spot as to lead marketing. And he hated intermodal with a passion. And he said the railroad would be better off without it. The guy that was head of operations that took that over, when Bill Greenwood got demoted to head marketing, he just hated intermodal with a passion, and he believed in financial accounting rather than managerial accounting. Bill Greenwood is the only guy that got it, which was very, very unfortunate. And we didn't have Dryas Gaskins around. Gaskins got it, but Gaskins was long gone by that time, not even on the board. It was just really kind of sad. And I don't understand why the board didn't get it. But I understand that the board was only, like rationed information. They were kind of like kept in the dark on a lot of stuff. So I don't know. I wish I had an answer for it because it was sure frustrating.
Let's go to
I
Cal
just heard-
Silverberg. Cal, you have a question?
Cal was there. He knows.
Oh boy, was I there, Mark. Thank you for the presentation. It was an excellent job. Loved hearing the stories directly out of your voice after reading your words. What I can add to about what was going on at the C-suite was that very honestly, the lower levels of the company were embedded into the old way of bulk and coal and intermodal doesn't produce the margins we need because everybody was looking at how much margin does this one car produce on this trip, and that was it. Whatever was the highest was the one that got the resources applied to it. But as you can hear from the way Mark described it, there weren't many people who came up through the ranks who were in the C-suite at that time. So they came in with their own biases and own preferences. Plus, they were being fed with the biases and impressions of the people directly underneath them, the old heads who've been there for a while. So, of course, the people in the coal department and the Alliance division, Nebraska division, they would be pushing for coal and screaming for coal, talking about how big the margin was for each car. Uh, for whatever reason, BN never grasped the concept that it's the total margin you need to look at and properly how to account for incremental margin as you went along. And that as you lost business or gained business, it was the incremental margin that came to the bottom line, not the fully allocated margin. What this whole thing taught me in my career was that never, ever, ever, ever look at fully allocated costs, because you never knew how the allocation game was played by the people drawing up the numbers.
Also, Cal, return on assets was not something that was really part of the, the recipe for doing business at BN. I mean, we did an intermodal. We were passionate about it. And then Phil Weaver, when he came into the grain area, and Rich Carter, they got it.
Yep.
But it was tough beyond that.
Yeah, very tough.
But you
Very
could
tough.
survive with a lower margin with a superior return on assets. You just turn the crap out of those assets. How do, how do grocery stores make it? Well, it's not a perfect parallel to a railroad, but holy smokes. I mean, BNSF shuttle trains now, 36 trips a year on cars, where we were trying to get 12 to 18, that kind of a thing.
Mm-hmm. But anyway, that's all I wanted to add to it, Brett. But thank you very much. I appreciate it.
Thanks, Cal.
Dave, thanks, Cal. David, do you have another question?
Yes, one last question. You talked about how you see natural efficiencies in intermodal for a transcontinental network.
Mhm.
Do you have any thoughts with regards to non-intermodal business and the impacts with non-intermodal business, and how to look at that in terms of the current proposed UP-NS merger? And certainly if you're doing consulting or anything where you can't comment on it, I understand completely.
Yeah, I'm not doing any consulting on it. I just mentioned to Brett before we got on, we were kind of like talking about this a little bit. And I said to him that when it came to the BN Santa Fe merger, I was on the merger team and I was running intermodal, leading up to that. And intermodal was the only part of the plan, of that merger plan, that had really any significant commercial synergies attached to it. The whole merger was justified based on cost reductions. And that was in the stuff presented to the boards before the merger, which I have in the grain book. And it was also in the application. And they actually increased cost reductions and removed commercial synergies in what went to the ICC application, which that's also in the grain book. In fact, the grain business on BNSF, over 70% of the growth since the merger has been related to merger markets, which were not in the plan, not even thought of in the plan. By that I mean, dairy farmers in California getting corn and corn and soybean products from the Midwest. The feed mill or the feedlots in Oklahoma and Texas, Mexican exports. 70% of the growth has been related to the merger. None of that was considered. And intermodal, we saw incredible synergies, from having a broader geographic footprint. So I'm frankly on, Venice side. I believe that there are a lot of commercial growth opportunities related to a UP-NS merger, because we sure saw it if we would have been able to put together that BN, Santa Fe, NS combination that we tried, which Rob Krebs tried to do. He tried to do that before he tried the CN combination, before he moved on. So I don't know if I answered your question adequately or not, but oh yeah, great commercial opportunities and great operational synergies too. Like, with the drayage networks, if you have that broader network, it's so much easier to get balanced hauls in your drayage, in your feeder zones, your drayage feeder zones. If I'm only serving from Chicago to Seattle, and I have a load going out to Columbus, what's the probability of me getting a load back to Seattle if that's all I have in my railroad? But otherwise, if I serve Denver, if I serve California, if I serve Texas, I have an opportunity to get a move in that drayage zone back to the hub center to one of those markets to get two-way hauls, that kind of a thing. Triangulation of equipment, huge, huge opportunities with the broader network. And, that was what, we lived on, and that was what we were striving for. Does that help?
Thanks,
Yes,
Mark.
thank you for
Okay.
the detailed answer.
There's two hands raised, but I've got a question here from a student who asked me to ask it for you, Mark, which is, says, when you were working in equipment management, how successful did you find investments in early technologies when it came to new locomotives or railcar technologies, whether in terms of different propulsion systems or automation level, though that may be a little bit before your time. I don't know. Do you find risk aversion in the industry among different railroads as higher or lower between then and current years?
Risk aversion increased dramatically at Burlington Northern as soon as Bill Greenwood got dehorned and after Dryas Gaskins left. BN was a leader in research and development in the industry. It pushed it. And we in Intermodal Cal, you remember this, we tried every piece of new technology equipment we could come up with. BN had the ARIES system going, the precursor for positive train control, all this stuff. And that died because we had a CEO that said, I don't want to be out front. I don't want to, I want to let everybody else take the risk. So I'll answer that second part first. Okay. Um, I talked about the SD70 Mac locomotives. They were an absolute breakthrough because we got 3-for-5 capability with those. 3 of those locomotives would take the place of 5 conventional locomotives. And also because they were AC technology, you didn't have the issues with minimum continuous speeds that you had with DC technology, where a train would if you get too low of a speed, you're going to burn out your traction motors. Or, starting from a stop with an AC locomotive, you can start from a stop on a grade like you never could with a DC locomotive. And if I'm talking in too great a detail, I apologize, but those are examples. The C44 locomotives the Santa Fe bought for intermodal. I mean, holy smokes, the fuel economy they got compared to ours, that was a game changer, and we weren't able to take advantage of that. On the equipment side, double stack. Holy crap. What a difference that made for the economics of intermodal business. In the grain area, going to 286,000 pound capacity cars. Well, first off, going from box cars to jumbo covered hoppers, what you talk about in the grain book, total game changer. Then you go from 263,000 pound technology of grain cars to 286, the heavy axle loading cars. Total game changer. Then post BNSF merger, they went from 60-foot grain cars with 286,000 pound capacity. They increased the cubic capacity so that they could weigh out with wheat or with corn, as well as corn and barley, as well as with soybeans and wheat, because wheat and soybeans would weigh out before they'd cube out in a 286,000 capacity car. So they increased the cubic capacity of the car, keeping that same weight capacity. And then they started to shrink the size of the cars, going from 60-foot cars. Now I think they're buying 54-foot cars. So now you can get 117 feet or 117 cars where 110 cars formerly fit on your elevator tracks, for example, and in sidings, for example, that are limited to 7,000 feet, for example. So, oh my gosh, yeah, all kinds of opportunities in the equipment area as well as the locomotive area.
I get the sense that the railroads, at least currently, are embracing innovation and new technologies. So I think part of her question too is, and I'm going to go to John in a second, but maybe if we have time, we can get back to it. Is kind of what is your sense, having followed the industry for all these years, whether there's more of an appetite to invest in innovation and new tech now versus maybe when you were deeply immersed. But let's get back to that if we have time.
Okay.
John Woodcock, you have a question.
Yeah, hi, Mark.
Hi.
Yeah, and this touches on a few of the things that you were just talking about. And my question was, you were pretty early in the game in your career, BN, with regard to domestic containerization. And I was wondering what your perspectives were at the time with related to the comparative economics between domestic containerization and the trailer market.
Well, it depends on your length of haul. If you're talking about like haul lengths, and it's difficult to give you absolutes. You can't, because it depends on density of lanes, how balanced are your drayage movements, that kind of stuff. But your terminal costs are higher with containers, um, a lot higher per unit for a container. So you're going to have more haul miles in order to spread those terminal costs over. So trailers will be more competitive in, say a 700-mile haul that rather than a domestic container. But overall, domestic containerization was a game changer for your long distance haul markets. Um, and we were on the forefront of that. That's why we put BN America together. And we use that not only to try to change the economics of the business to make intermodal much more profitable, but to give it a better service quality too, because you eliminate slack action in the train, eliminate blocking and bracing, which was a penalty that you have with trailers. Okay, if you're moving trailers on conventional cars, unless you have all 10-pack cars with limited slack, more articulation, you're going to have to block and brace like for a war. Well, you don't do that over the road. So that was a penalty that you had compared to the over the road carrier. Another thing that we tried to do with BN America was change the whole commercial relationship so that you wouldn't have shippers agents, but rather carrier agents. Because we had, you know, you have 100 shippers agents out there and they're all beating each other up trying to get that same business and trying to convince you that you need to lower your price to get that business which you're already carrying, because the railroads didn't have control of their commercial channels. That was a game changer for us with BN America. So that's related to the domestic containerization thing too. I don't know if I answered your question, but if I didn't, let
No,
me
you did. Thank you
Okay.
very much.
Okay.
Hi, we have a question from Ed. Ed, could you please let us know who you are and then ask your question? I've asked Ed to unmute. Hopefully we can accomplish that. If not, while we're waiting, Mark, do you want to weigh in on the, kind of the question that I asked you, kind of how do you see where railroads are today versus, 20, 30 years ago as far as investing in innovation and technologies?
I'll be honest, my sense is that since I'd say in the time between when the industry was kind of like in meltdown because of the UPSP merger and the problems with that, and Conrail being absorbed by Norfolk Southern and CSX. There was a period there where the industry was so inwardly focused, and then all of a sudden it got pricing power, and it was able to get prosperity by raising prices, starting in around 2004 or so, until you know until the government mandated PTC. My sense was that the railroads were not aggressive in R&D because they didn't need to. It was like, things are going so good that we can, you know, cut dividend checks basically. Well, PTC changed that because they were mandated to do that. And, that was an awful lot of money that was stuck into that. And I don't know if they'll ever get a decent return on that. So that absorbed a lot of money that could have been used for other types of R&D. And I sense now, though, that you're seeing more of an emphasis placed on R&D. I don't think that I'm concerned about railroads saying, having a not invented here mentality and not structuring partnerships with vendors of new technologies. I sense that there's some of that, and we fought that in Burlington Northern. Like in Intermodal, we said, we don't care who did it. I mean, we'll take all comers, just bring us the ideas and we'll work with you. you know. So I don't know. That's just my perception. I'm sure there are
Thank
others
you.
on the line that have a better better sense than I do for
I
it.
just it's just good to get different perspectives, so I appreciate it.
Okay.
Norm, if you want to rejoin and help us wrap up. We will, we're recording today, so we'll send out a recording to the Sandhouse listserv. And there was also one request, Mark, of where someone can find your books.
They're on
And
Amazon.
yeah, so I'll look at your presentation. If I need help, I'll ask you, but we'll put that in the summary that we send back out. So we'll let people know where they can find some of your books, since there's the interest was expressed. So happy to
Okay.
do it. Norm?
I think that the advent of PTC has caused a renewal in railroads' interest in technology, particularly in data processing and crunching information, as well as looking into more applications of PTC itself. So I agree with that statement, that I think that there has been somewhat of a renewal. The other thing in the technology area that I want to mention, and I'm not sure it's really technology, it's just adaptation of a different concept, is DPU, distributed power. And that has impacted operations. UP, for example, is putting together 2-unit coal trains for the majority of the haul, and then they can just split the train as they get closer to the destination. And particularly the reverse in taking the empties back west. Someone even said they thought they put 3 trains together. That I would put in the rumor category, but things like that. And if you notice the way the power is placed in some of the trains, you can see that they're using basically a longer train for the mid haul and shorter trains for as you get closer to destination or even origination to begin with.
Like hub
So
and spoke.
yeah. So I think that there is a lot of looking at technology, and of course, the big question is what are railroads doing or not doing with AI at the moment? So, and I'm wondering where that's going to end up. But this has been a very interesting presentation, and I know that Rob Krebs got very interested in intermodal shortly after. Reason I know that, phone rang. Hi, Norm. This is Rob Krebs. I received your phone number for somebody else. Can you arrange? I understand you can arrange a trip for me in China, which we did. And Rob came back and he said, boy, the person you introduced me to was Nellie Fong. She knows everybody that was anybody in China. And did I learn a lot about intermodal traffic coming out of China? So that's a personal experience that with Rob, it was quite rewarding for him and ultimately for Arthur Anderson.
Mhm.
Thank you very much, Mark, for what you bring. I'm glad that we're talking with Tony about a date sometime in winter. And I think it's going to be very interesting as the Union Pacific Norfolk Southern thing works along. The question I will throw on the table is how do you define the enhancement of competition? I think that is going to be a very interesting question that as you come out of this process, and what is the definition of enhancement of competition for a railroad? But in any event, thanks to all that attended. Thanks to you, Mark, and look forward to announcements of our next Sandhouse meetings.
Yep.
Thank
Thank you
you.
for the attendance today. It was a nice group that showed up. So thank you.
Thank you again.
Thanks,
Bye.
Mark.
Okay,
Thank you,
bye.
Norm. Bye, everybody.
Thank you, Brett.
You're welcome. Take care.